Hello everybody. I'd like to share some thoughts this afternoon that I hope will be helpful to you in forming conclusions about the attractiveness of investing in the gold space now. I've targeted my remarks for those generalists in the audience who may be new to gold, so if you're an old hand, I'd ask for your indulgence now. Gold's both a timely and timeless subject, and you don't need to be a gold bug to generate investment returns from it. So gold's currently trading around $1,740 an ounce and has attempted to break through the $1,800 mark a few times over the last few months, only to be thrown back. Is $1,800 the top, or is it only the end of the beginning of this newest price rise? Can gold prices break the all-time high of about $1,900 from September in 2011? If you invest in gold companies doing business around the world, the question might be easier to answer because you know that gold prices in other currencies are already making new highs on a frequent basis. Why isn't the same thing possible in US dollars? I suggest new highs certainly are possible, and here are a couple of reasons why I think so. One of the biggest knocks against owning physical gold has always been the argument that gold bears no interest and therefore represents a lost opportunity cost for the investor. This was the centerpiece of the argument used to convince central banks to sell or lend their gold reserves decades ago. Why own it, other than for use as an inflation hedge? The old saying is that an ounce of gold can always buy a good suit. Or why own it unless you're going to have the ultimate in a safe haven asset? You have no counterparty risk if you have the ounce of gold in your hand. With governments and companies selling 100-year bonds at low interest rates and negative interest rates included in almost every central bank's policy, I think the opportunity cost argument is pretty well weakened. Now, besides the absolute price level, is there some other way to tell if gold is expensive or cheap? Institutional clients always found this chart interesting. It shows the relative size of the U.S. monetary base compared to the value of U.S. Treasury's gold holdings. The U.S. remains the largest holder of gold at 261 million ounces. And yes, I'm giving an unseen wink and a nod to those who say, who really knows if it exists? You see that there are two spikes which represent times of gold overvaluation in 1938 and 1980. And following those spikes, financial assets outperformed while gold prices fell or remained constant. Remember that the gold price was fixed in price until 1971. And in 2000, at a point of radical undervaluation, the world central banks sold their gold holdings. In fact, the Swiss and British sold at almost the lows of around $250 an ounce. Look where we are today, with the ratio basically at its lowest point, which represents radical gold undervaluation and indicates gold price outperformance versus financial assets going forward. This is with gold already reaching for $1,800. And clearly the explosion in the size of the monetary base is helping the equation in the case for gold. But are there other indicators that point to a fall in overall demand from these high price levels? And traditionally, about 50% of global demand comes from jewelry. And there are many nuances such as seasonality and import taxation levels in India that would require much more time than I have here. All else being equal, high prices and a weak Indian monsoon season don't help global jewelry demand. But I'd like to focus on a few recent indicators that signal gold demand remains strong even at these price levels. The first indicator is the central bank gold demand, which has been tremendously strong. This is following many years when central bank selling was the norm. All central bank sales basically stopped by 2012, but some countries, such as China and Russia, have been increasing their gold purchases until very recently. Bank purchase records were being broken until COVID appeared, but a recent survey by the World Gold Council found that central banks overwhelmingly plan to continue to purchase more gold as they diversify away from US dollar holdings. We've also seen recent, very large increases in demand by investment funds. Gold ETF inflows have been rising rapidly, and should these inflows continue apace, the annualized numbers are staggering. They represent a tremendous percentage of global annual gold production. So where will all of this additional gold come from, and what gold price will it take to make it available to the ETFs? And okay, here's another silent wink and a nod to those with the doubts about whether the ETFs even actually have the gold. And as a final indicator of why I think gold prices are inevitable, there are supply issues to be dealt with. Gold production faces all the other headwinds that any other commodity faces, but to me the most important and the hardest concept for generalist investors to wrap their heads around is that of resource depletion. And I think I understand why, because in any other industry, the components needed to physically produce something are always assumed to be immediately or almost immediately available at some price. Therefore, stable production of iPhones or bicycles is assumed to always be possible, though perhaps with some lags associated with an increase in production. It's not quite the same with natural resource producers. For a given industry in a sector, such as gold, it's true that there's always a component of price sensitivity that will unlock more product. This is the concept of economic reserves, and why we'll never run out of any oil or any other commodity. But there's a catch to it, and that catch is that individual producers in the mining industries build and operate their mines according to detailed financial and production plans, and these plans are centered around the extraction of a defined amount of economic reserves for a given project. We know that maximizing the net present value of a project almost always includes getting the highest grade material through the mill first, and during periods of low prices, we also know that mines will high-grade their resources in an effort to stay afloat. As a consequence, as mines get older, they almost always exhibit a decline in production because they are often mining the lowest grade material out of what they once had. Now, if you stack up all these individual mine production profiles, you arrive at the cumulative industry decline rate. This built-in headwind must be overcome to simply keep annual production flat. The gold industry is no different than any of the other metals. New mines must be developed to replace the old. Around 2015, we calculated the gold industry was subject to about a 4% depletion rate. I doubt it's changed much since. To overcome that, you have a backdrop in which it's never been more difficult to develop new projects. Aging mines, permitting timelines, political risk, government interference, social license, and environmental concerns all hinder additional production. Just look at how the industry's changed in response to those challenges. As just two examples over the decades, the unchallenged leader in gold production, South Africa, has fallen tremendously as their old mines reached unbelievable depths and political instability increased, while China's emerged as the world's largest producer. I'd like to end this presentation with this last thought. This is the life cycle chart of a mining company, commonly referred to as the Lassonde curve. It honors Pierre Lassonde, the co-founder of Franco-Nevada, who used the chart to explain periods of relative strength and weakness in share prices as companies progress through the different development stages on their way to production. This is assuming that a company makes it all the way from the left to the right, because very, very few do, which is an important consideration for you as you invest. Because of all the headwinds the industry faces, I think the valuation peaks and valleys of this chart will compress, even if the timeline to production is actually expanding. As higher gold prices generate higher cash flows, gold producers will be looking to buy replacements for their reserves. Many of these larger companies slashed their exploration teams when gold prices were low, or simply acknowledged that exploration wasn't their strength. As M&A once again increases, along with the fear of missing out, in my opinion, transactions will take place at earlier and earlier stages on the curve, and probably at higher than historically seen valuation metrics. I think that gold prices have a lot farther to rise, And while you could make the argument for a doubling or tripling of prices, maybe we wouldn't be too happy with the shape of our global society if we got there. But gold prices don't have to double for gold stocks to do well. As investors, we understand the operational leverage that companies enjoy when the price of their product rises significantly. But if you're new to gold investing, you may not be aware of how high industry costs are, and that the opportunities to reduce costs are few and far between. That high cost base will magnify the positive effect of rising gold prices. If gold prices achieve only a significant portion of the gains many analysts now expect, the prices of all gold stocks, in my opinion, will be multiples of current levels. I think it's a great time to be investing in the space, and I encourage you to find out more about gold. Thank you for listening, and I'm certain you will enjoy the following presentation.